Well, good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive-Through on this Wednesday, November the 9th, 2022. Thanksgiving is just 2 weeks away. Can you believe it? 2 weeks away. I hope you got your turkey, because I understand that there's been a turkey shortage, and there's a turkey shortage in the United States right now due to some kind of avian flu. I don't know. There's always something, right? Today's topic, what's next for interest rates and real estate? Obviously, the midterm election is now behind us. And regardless of whether you got the outcome you wanted or not, the market's going to do what it's going to do. And we pretty much know that interest rates are going to keep going up, right? So that has impacted the stock market, of course, but it's going to have a major impact and possibly already has begun to have a major impact on the real estate market. So I'm very happy today to welcome Mr. Chad Stevens. Chad is with Oklahoma's Credit Union.
Yes, sir.
And he's a real estate relationship specialist and knows a lot about the mortgage lending side of things, but also gives some insight into the real estate and the impact on real estate. So we're going to spend some time today letting him share with us his insights. And then, of course, we're going to get your questions answered here in just a little bit. So, Chad, thanks for joining us today.
Well, thanks for having me, Damon.
Yeah, absolutely. So I'll tell you what I'm going to do. I'm going to stop sharing this. And what I am going to do is share your presentation.
Yeah.
Oh, that's not what I wanted to do at all. So let me get off of that and we come over here. See, when you do this live, ladies and gentlemen, you get to see all of the technical difficulties.
It's a live.
That's right. There we go. All right. So we've got that going on there. Let me make the screen bigger there. All right. I'm going to step out of the way here and let you take it away. We've got the camera right up there, so go for it.
So Damon was telling me one thing we like to do on here is that we actually like to dispel a few myths or misconceptions about just things that we've heard. So I'm pretty well say that most of you are familiar or at least heard of the adjustable rate mortgage. And if you're unfamiliar, this was something that was created in the 1980s to help minimize rising interest rates. But what you probably aren't aware of today is that there are a number, there's a number of protections in place that actually protect the consumer or the buyer here now, that you're not seeing a rate change within 6 months of getting your mortgage and the consecutive 6 months for 30 years. There's actually hard, fast adjustment caps that are fixed at the beginning. For example, on your screen there, we have our 15-15 arm through the credit union. So that first 15 years is fixed. On average, people stay in their homes for 7 years. They may never see that first adjustment. And the adjustment caps are all regulated now through the credit union. Our adjustments are 2%.
Okay.
Up or down. So
just to clarify, I mean, one of the big negatives against adjustable rate mortgages was always, well, your rate can change every 6 months or every year.
Yeah, that is not
But
the case.
in this case, you can actually lock in for a certain period of time, and then I assume possibly refinance later down to a fixed rate if rates ever fell again.
Sure.
And so that's kind of interesting.
And the best part, there's no penalties included with this either. So if there's no worries for repayment, the only thing you're going to do is just go back through the closing process again. It's very, very quick and seamless now. There's when people actually give it a chance, it's usually a pretty good fit for most folks.
Yeah. And so if we've got this, then what would be the benefit now? Because people, again, they're like, I want a fixed rate, I want to know my bill is going to be the same. So if now you can lock in for a certain period of time, what is the benefit of doing that versus just going ahead and getting a fixed rate mortgage? Are you seeing lower interest rates possibly?
Absolutely.
Okay, so that's kind of the carrot is you can get a 30-year fixed rate mortgage, but right now, let's say you get it at 7.5%. But with something like this, maybe you could lock in at 6.
Probably about 6 1/4,
6 1/4,
7, and it depends. There's always some more customization that comes with an adjustable rate mortgage, which is nice.
Yeah.
One of the reasons where people ask, well, why are they able to make interest rates lower on an adjustable rate mortgage? Well, on a fixed rate, we have to assume that the market's going to shift between now and 30 years to this mortgage's completion. So they have to anticipate that full amortization schedule for the full 30 years on 30-year fixed, and they have to make sure that there's going to be the right profit margins, right?
Right.
With an adjustable, that you've shortened that time between the adjustments on there, so you can be more upfront, lower upfront on that side, because you are going to have adjustments that are built in down the line. So it does save you up front.
Yeah. And again, you've got the opportunity to, at least for a period of years, lock in your rate.
Yeah.
So,
So it's a great product.
yeah, I mean, to me, if you're looking to acquire, and again, we're not here to sell mortgages through Oklahoma's credit.
Right.
But
This is, yeah.
but Chad is bringing this to us because this is something, like a lot of you, I have been pre-programmed to hate adjustable rate mortgages. Okay. They're too iffy. I want to know what my monthly payment's going to be for the entirety of the term. But the problem is right now, if you're going to go out and get new financing, good luck. Even if you have excellent credit, finding a rate 7% or under 7%. That's just the way life is right now.
Unless you're willing to shell out discount points.
That's right.
That
Gets
gets
pay 1 or
costly
2
quick.
points, and then if you're buying a $500,000 house, 1% of $500,000 is $50,000. So you got to walk to the table, the closing table, with an extra 50 grand, to do that. So that's why I think this is kind of interesting that you can lower your rate, but then reserve the opportunity to refinance to a fixed rate when rates go back down.
Yeah, it's a good tool. It's especially for people who are watching each dollar as it's coming.
Okay.
This.
All right.
Yeah, so that's what I have for that. So we can get to the meat and potatoes about the outlook in the future.
Yeah, so and again, ladies and gentlemen, I want to invite your questions. This is always more fun when you guys ask questions. And so whether you are looking to invest in real estate, you're looking to downsize your home, and so maybe if you're going to have some cash on hand to pay for it, fine. You don't have to finance. But here's the reality. Even though your home price is elevated, well, to go out and find another house, that home price is elevated too. So it may not be a cash for cash, a dollar for dollar trade. So what are we seeing with interest rates now? I mean, what would you say the average mortgage rate is right now for someone with good to excellent credit?
Well, if we're talking fixed rates here, just the average we're looking at is just over 7% national. And Oklahoma, we're a little bit, and I wouldn't say immune to some of the coastal effects, but we're a little more resilient. Yeah. We are actually looking right around that range too, so we can be right towards the national average instead of being one of the outliers. That's 7.5.
And are you starting to see an impact then to the number of, is the real estate market beginning to suffer right now? Or is it still pretty hot?
Suffer is not the term I would use. It's slowing down because we're not seeing the negative sides yet. There's not a big jump in foreclosures yet, or anything like that. Okay. So it's cooling, and people are still able to make transactions. It's just slower. We're seeing 6 months ago, national time or average time was 3 days on the market.
Yeah.
That has changed to 20 days, 25 days now. So each deal is cooling off. For people who are selling their homes, they're not having to go through 25 offers same day. They're being able to look at more, maybe 1 or 2. Yeah. And so that's slowed down quite a bit. And for buyers, people who are actually, if you're looking to downsize or just looking for a new home in general, there's more consideration to each offer that's coming through. So we're seeing concessions come back, which is something that didn't exist in the COVID market. Yeah. So that's a sign that times are changing back to a more balanced market, which is nice. Yeah. Now, in terms of where the interest rate's doing that's really the driving factor on there. When the Fed's bumping up, we have to follow, and that's continuing to cool the market. So they're hoping that that's going to help battle inflation.
Ladies and gentlemen, like I said, if you have a question at any time, and I keep looking at this camera here, the camera's right up there, so I apologize for that. But if you have a question that you would like to ask Chad about interest rates or the real estate markets, you can put it down in the chat or the Q&A button down in your toolbar down below, and we'd be happy to answer that question. So pull out your crystal ball. Okay. All right. So it's crystal ball time. Well, let's not do a year yet. What do you believe the Fed is going to do with interest rates? Or what is the credit union preparing in terms of interest rates over the next 6 months? In short, when do you think the Fed's going to stop raising rates? Have you guys had those kinds of conversations?
We've had those kind of conversations. We're anticipating that the Fed's going to continue to raise basis points at a slower incline though. It's not going to
Okay.
be, we're hoping to see that it's not going to be that 75 basis
So
points.
maybe 50 basis points. or
Right. We're anticipating that it's going to, in December, probably going to be 50.
something. Okay.
And that trend will probably follow the next couple of months. And then probably around the end of the first quarter, where it's maybe a quarter in basis points.
Interesting.
So that's the anticipation. And so as that changes, we're going to hopefully see that inflation rate either stand still again or start coming back down. Because once that happens, once the Fed does decide to come back down, that's going to when the market just opens back up.
Yeah. Well, and I personally, I think the market will open back up just with the Fed stopping raising rates.
I think so.
You know, at this point, I think it's one of those things that just stop it already. Okay, just stop raising rates so we can all have something to look forward to. And you know, and to your point about, yeah, I think the Fed will begin to taper back on their rate increases between now and end of first quarter. I mean, how many more rate increases do you foresee before they stop?
Before they stop,
I'm putting them on the spot.
yeah, it really is. It really is. I wouldn't be surprised to see 4 more increases by probably the middle of the year.
Okay.
We're going to probably follow each month. And like I said, we hope to see that they are smaller increments as far as increases.
Yeah.
But we do kind of anticipate that it's going to continue.
I
We
think-
won't probably see a really downward trend probably until 2024.
Yeah, I agree with that. I certainly don't think the Fed's going to turn right around and start lowering rates. I think, honestly, in kind of what we've been sharing with our clients, our expectation is that we just had a rate increase last week for November. There will probably be another rate increase in December, probably another rate increase in February, and another one in March. And then we think the Fed might take a pause at the end of the first quarter and allow their rate increases to continue doing their work. Now, that was predicated on their top rate being 4.75%, something like that. Well, Fed Chairman Powell came out and said, well, now we might push it up to 5. So you could be right. There could be another rate increase as we go into the second quarter of next year.
Well, you did ask for the crystal ball.
Well, I did. And you pulled out the Windex, you shined it off.
I did, yeah.
We need the magic 8 ball. You know, is there going to be rate increases?
Ask you
Not
later.
yeah, ask you again later. That's probably what I was going to say. All right, so suffice to say, there are going to be more rate increases in our future. What then does that mean for the real estate market? So is real estate, which is still really hot, it's a great asset to own. I mean, of all of the investment classes that you can put your money into right now, there are 2 that are still winners: energy and real estate. Okay, everything else, including gold and other precious metals, everything's losing. In fact, ladies and gentlemen, if I haven't shared this with you yet, this is, I think, the first time ever, or maybe one of 3 times going back to the Great Depression, that stocks and bonds are down in the same year 15+%. I don't think it's ever happened before in our country's history where bonds and stocks are down 15% or more at the same time. It doesn't happen. It's the definition of a black swan event. Now, that's the market. What do you guys see in terms of the prospects for real estate over the next 12 months?
We're seeing right now, and this trend, we're expecting it to probably continue, probably middle of the year next year.
Okay.
As people are doubling down on their equity. Let's get something liquid, create cushion for themselves.
Okay.
So that way they can absorb some of the impacts that are coming at them. There's not a lot of big growth that's happening, at least on the buyer to buyer perspective. Commercially, there's a lot of properties that are still being moved on there. So that's it's good business is still growing. But as far as just the consumer is looking, it's slowing down, and people are doubling down to bat in the hatch. They want to have that liquidity. They want to use the equity, especially now that the prices have gone up as much as they have.
Yeah.
They're basically giving themselves an extra $25,000-$30,000. Why not?
Yeah.
Let's make it real.
Yeah. And now, what about interest rates? So we're talking about a home equity loan, right?
Yes.
HELOC, basically. Which if you're not familiar with the home equity line of credit, it's basically like a revolving line of credit, similar to your credit card. There's a certain amount that you can borrow and use. Well, the home equity line of credit, your house, the equity in your house is your collateral. And you can borrow against that equity and use it for pretty much anything
Yeah,
you
pretty much
want.
anything.
Although I don't think you're allowed to take it and invest that money, right? You can't take the line of credit and then put it in the stock market. Right? I don't think you can.
It's not encouraged.
Yeah.
So
I wouldn't do that.
yeah, I wouldn't do that.
I wouldn't do that. But yeah, with home values up so much, a HELOC can be a great way. And quite frankly, you could apply for one. You don't have to use it.
You don't
It
have
doesn't
to.
cost anything. Well, other than maybe some closing costs
Yeah.
and things like that
Mhm.
to do that. But you never have to use it. And it's nice to know that,
It's there.
yeah, it's there.
It's, it's Big Brother looking over you.
So are
But again-
the interest rates on a home equity line of credit similar to new mortgage rates, or is there a difference?
There is a difference. HELOCs usually run on the Wall Street prime rate.
Okay.
That today is 6.25%. So that by itself there is actually lower than your fixed rate mortgage today nationally. And the way that works on there is that like Damon was saying, it's the equity in your home up to generally 80% of the
Okay.
home value. So that way you have that, and it's very functional. It's good to keep people going, and you can use it not in the same sort of investment on there, but you can use it for purchases. Sometimes folks, other real estate investors will sit there and use it as down payments for new
Mhm.
homes, and then take that and put it into permanent financing.
Yeah.
It helps kind of keep that cash out of your pocket, or in your pocket rather.
Yeah. Yeah.
So
Well, that's an interesting concept to use the home equity line of credit as a down payment on another potential investment property, something like that. Interesting. So, are there any questions? Does anybody have any questions? You've got a real estate question, you've got a lending question, or an interest rate question. Now's your time to ask. You can use the chat or Q&A function down below. Did you have anything else here on your presentation, Chad, that you want to share?
Really, it was mostly just kind of help dispel those myths. This is to give your listeners just another tool if they're looking to make sure that they're well informed.
Yeah.
Don't be afraid of the adjustable rate mortgage just because historically they were bad, because today they're a great asset.
Yeah.
They're a good tool to have in your belt.
Yeah, well, especially right now with the rising interest rate environment.
Absolutely.
If you can get a loan to accomplish the same thing, that is going to get you a lower rate, and you can lock in that rate for
5,
10
15 years.
that gives you enough time to, number one, build a budget for the next few years. You know your payment's going to be level, other than if your property taxes or insurance go up. Okay, if you're rolling that into your overall payment, but there's always the opportunity to refinance later on down the road.
And even for some folks on there, the 15-15 arm, depending on where the market's at that first adjustment, that's the adjustment that they would see for that full 30 years on there.
Really?
Yeah. So, and if the market, which is possible to come down from where we at, we are technically right now at a 20-year high on there, but historically over since the 80s, we're still at more reasonable rates. But if that came back down to 6, you would know, without having to refinance, your payment would come down.
Yeah.
And that adjustment would be there for the rest of the term on the loan. So it's good for really everybody who is interested in listening. There's usually a benefit for somebody.
So let me ask you this. One of the benefits that we try to bring, or one of the values that we try to bring to our clients, is it's not just that we've got all the answers. We don't have all the answers, but more important is asking the right questions.
Absolutely.
So in your experience, because you've been you've been in the lending side for how many years?
I've been in lending for about 7 years.
Okay, so 7 years. So you've had plenty of opportunity to see and do a lot. In your experience, what's the number one question? If someone is looking for lending for a mortgage, whether it's to live in the house or for investment purposes, what's the number one question people should ask first, just in your experience?
Where to start?
Yeah, where to start?
See, so really a lot of people is just to know what's going to be the best product for them, for people who are looking at the investment side on there. If to get cash back out of your mortgage, you have really 3 options. You can do a first refinance with cash out, you can do a HELOC, or you could do a second mortgage. But which one of those is going to be the best fit is going to be case by case. So instead of having a singular question, it's just It would be what's my best fit for my situation, because every deal is different. Everybody has a different lifestyle, everybody has different needs, but something will fit and it will be the best fit. You just need to know to ask the question of what can we do to get there.
What are some of the, again, I'm asking these questions because things change all the time.
Yeah.
So have there been any changes to, is there any more emphasis, let me put it this way, with credit scores, okay? Because everybody wants to know what's my credit score, that sort of thing. And how does my credit score impact my interest rate? Are we seeing compression in credit scores, meaning that it takes a higher credit score now? There's a smaller range to qualify for the best rate, or have those expanded? What does that look like? What should people expect if they're looking to go and get a mortgage on a second home, downsize, whatever?
There has been a little bit, especially with the secondary market, Freddie and Fannie on there, they still have their guidelines. Those aren't going to change on there. But in terms of the internal product of a mortgage that'll stick with an institution, the credit scores aren't really changing too much on there as far as guidelines. The biggest thing probably to know going into it is having a strong loan to value on there, because that's going to actually mitigate the most risk from the lender's perspective. So, I mean, if you come to me and say, well, I'll put 20% down or I'll put 3.5% down, which deal would you be more comfortable with? So,
Right.
And so that is kind of leaning where you would want to see a larger loan to value than just the minimum down.
Right.
So
what you're saying is that there's a potential that if somebody's, let's say you've got a piece of land and you're building a house on it, okay, and the value of the house and the land is $650,000, but the actual construction, the cost to build the home is $500,000. So there's a significant difference between what the land and the house is worth versus what it actually costs. That's a situation where maybe they wouldn't have to put as much down.
absolutely,
Or maybe anything at all if the numbers worked out.
yeah, because where you would sit on there, you would fulfill that basically built-in equity on there to hit where you need to qualify on there. Plus, and when you start working with products that are specific to institutions, sometimes there's different rate breakdown based on the loan to value. So if you're coming in 20% equity built in because the cost was lower than the value, then you're going to get yourself an additional better rate just because the loan to value is right.
Yeah. Ladies and gentlemen, we've got about 5 minutes left here on the Wednesday lunchtime drive-through. I don't have any questions yet, but I encourage you, if you've got a question, maybe you're looking to downsize your home. Are you looking to purchase an investment property? If you've got a question, now's your time to ask Chad. He knows his stuff. He knows what he's doing. Again, our guest is Chad Stevens with Oklahoma's Credit Union. And he's been in the business, the financial institution, the lending business for quite some time. And this is a tough time right now. Interest rates are going up. There's no way to get around it. And if you're going to borrow money, whether it's on a credit card or you're going to get a car loan or a home loan, you're going to pay more for money to borrow somebody else's money. What are some of the other things that people should look for? When they're looking to, if you were going out right now and you were going to get a mortgage, okay? If you were me, or if you were our folks on the line today, what are some of the information that we need to have? What's the most important piece? What are the most important pieces of information that are going to give them the most favorable results? You mentioned a high or low loan to value ratio, okay? Or you want your value to be much higher than
the loan. Yeah.
What are some other things that impact that?
Honestly, one of the really important ones is actually shopping local.
Okay.
Mortgage brokers right now are in a troubled time on there because they don't have a lot of the same backing of having multiple income streams in a business like a bank or a credit union is. But shopping local, you have a good chance of knowing that the underwriting or the processing for a mortgage is done in-house, and that lowers your costs on there, because outsourced underwriting and processing sometimes can cost thousands of dollars depending on there. And then not on with that, origination fees, if you happen to have discount points in there, these are all costs that are going to come up that could be mitigated if you shop around, shop local, because having everybody in-house lowers those costs.
We do have a question here from Doug. So Doug is a real estate professional. And as I said, he's also a baker extraordinaire, makes wonderful cookies. He asks the question, are adjustable rate mortgages used for any other type of loan?
Hey, Doug. The adjustable rate mortgage on there is it's tailored for mortgages on there.
Or maybe he just means adjustable rates.
That's right, adjustable rates. There used to be car loans that were done that way, not anymore. You really don't see much for adjustable rates outside of the mortgage world. There are some commercial loans that function the same way on there, but that's not really my.
Okay. Let's see. Do we have any other questions that anybody would like to ask today about interest rates? Anybody have any questions like that? You know, I'm building a house right now, and one of the things that I keep, okay, so you get a construction loan, and that construction loan only lasts for a certain amount of time.
Right.
You got like a year, right? And right now the concern is, okay, if my construction loan runs out in May, and I'm maybe 65% complete with my house, okay? And this is true. I'm about 65% complete with my house. So far, I've not had any delays, but that could change. There are shortages, things like that. What does somebody do if they start to run up against the clock on their construction loan, and now it's time to get permanent financing, but the house isn't complete?
Call your lender.
Okay, so you can maybe adjust that timeline, move it back.
Sometimes most lenders do offer extensions on constructions because there are unforeseen circumstances. Look at what happened with COVID. There were just complete shutdowns. There were no supply chains. There just wasn't materials. So you had to file extensions for those. Extensions are there on there, and it usually comes down as case by case on there, making sure that everything's being done in good faith as it comes in. Obviously, supply chain issues, that's something nobody can control, especially not your builder. So that would be one of the things that could help qualify for an extension.
Okay.
Most of the time, they're done in about 6-month increments. Typically, you don't ever see anything more than 24 months.
So you could extend the original period of the construction loan maybe another 6 months. Too.
A lot of times they're baby step 2. You'll see 3 months, 3 months. That way, the way it's not over.
Makes sense. Yeah. Well, because the credit union or bank doesn't want to constantly keep that out there.
Well, and you don't want to sit there and only pay it.
Well, that's right. That's exactly right. So, well, ladies and gentlemen, it is 1 o'clock, and so it's now shameless plug time. So, Chad, tell us about Oklahoma's credit union and what is it that you guys do? What are the kinds of things people can expect?
Well, we're local through and through. We've been around since 1954. We actually started in an office at the Department of Transportation. Okay. And we have since grown tremendously in the past almost 70 years. Yeah. Okay. Yeah. And we, as a credit union, we put members first on there. So by doing so, we offer more competitive rates, access to education tools that you may not have otherwise. I know myself, I put on a number of home buyer workshops throughout the year for people who are first-time home buyers. Not a lot of those on the call probably, but it's there if you have relatives that are curious. Yeah. So have them come on by, we'll get you figured out. And that's our slogan. We're Oklahomans helping Oklahomans.
And is it, what's the membership? Is it like a community charter, anybody that lives in a certain area, or is it more of a specialized, how do you qualify to become?
Well, it's we're open to any state agency employee on there, but we also service anybody who lives in the surrounding counties of Oklahoma County on there. So if you live, work, worship, and any of the surrounding counties of Oklahoma County, we can take you guys on. We'd be happy to have you. We're always happy to help.
All right. Well, hey, thanks so much.
Thank you for
appreciate you dropping by, joining us for the Wednesday lunchtime drive-through, ladies and gentlemen. That's it for today. We hope that you enjoyed the conversation on interest rates, real estate. Of course, if you have any questions, you can call us here at ChappelWood Financial. If you want to get in touch with Chad, he's at Oklahoma's credit union if you're looking to get a mortgage or something like that. And if you want to later on, we have recorded this. You can go back. You can check out all of the past episodes of the Wednesday Lunchtime Drive-Thru. Just go to YouTube and look for the Financial Diva channel. You'll see a playlist there called the Wednesday Lunchtime Drive-Thru. I've got 30 plus episodes up there right now going back a couple of years. So you can watch to your heart's content, chock full of all kinds of great information. And we love to educate. That's what we're here. And again, it's not just about what you know, it's about asking the right questions. And that's what we're here for. So thanks so much for joining us today. Hope you enjoy the rest of your week. We'll see you next time.
Thank you all.